FY25 is ending, and what a tumultuous year it has been. The Nifty rose 20% in just 4 months, from June to September, and then gave up 15% of those gains in the next 4 months. The rupee fell a dramatic 4% in just 3 months, from November to February, and then pulled back 2.5% of that in just 6 weeks. GDP, one would think, is an elephant that turns more slowly. But no, from 9.2% GDP growth in FY24, we fell to just 5.56% in Q2 this year. So much slowdown in just 6 months. And then we have recovered quite smartly to really close to 7% in the current quarter. So today, on the last working day of FY25, I have with me 3 stalwarts to guide us as to how things may pan out in the fiscal year starting Tuesday. I have with me market veteran Nilesh Shah of Kotak AMC, economist Soumya Kanti Ghosh of SBI, and banker Rajiv Anand of Axis Bank. Gentlemen, thank you very much indeed for your time. Well, let me start with the growth question, because I would assume market and earnings are dependent on that. Soumya, we are starting at least next year with a lot of positives. There is a huge income tax cut. There is a huge liquidity gush. There are rate cuts. Do we have a better year for consumption, a much better year?
Yeah, thank you, Latha, for having me on the show. And I think you have put out the graphs nicely. The year which is closing next week, I think, has been a very remarkable year in terms of not only the macro variables, but also in terms of the political cycle. The elections were held in 64 countries across the world. More than half of the world population went. India had 2 budget presentations. India had also electoral cycles. And also India had 2 chiefs taking over as the regulatory at the end of the year. Having said that, to a specific question on growth, I think we have possibly seen the worst of growth is over. We had a 5.4% growth in the last quarter. The growth rate has since then recovered. But the markets have also recovered smartly in the last couple of days. The projections for next year is roughly around a consensus of around 6.5% headline GDP growth. But the good thing about the growth is that a large part of that will possibly be driven by consumption, because consumption growth has recovered smartly last year, and this year also the growth in consumption is likely to over the trend growth rate. It could be around 6 to 6.5%. So given these facts, I think the growth rate, even though it may not touch the spectacular highs of 9 or 8%, which we had after the COVID, but there could be a smart growth rate of around 6.5% in the next fiscal as of now. And it should be driven by a strong consumption growth as we see it today.
Okay. Strong consumption growth. Let me take the lead from there and go to Nilesh. Nilesh, rather than ask you about indexes and their levels, what would you bet on in terms of sectors? Banks were not the big performers in the year that was. Do they come back? Does consumption, consumer staples come back because there is so much money giveaway?
So, Latha, thank you for having me over here. I think Indian equity market is now moving from top-down to bottom-up story. We will have to bet upon entrepreneur. Technology is disrupting the world at a pace and at a scale which is unheard of. And any entrepreneur who is not riding the curve of technology adoption will become like dinosaur, a history. So markets are going to become far more bottom-up oriented. The consumer discretionary space from a sector point of view looks good. 1 lakh crore tax rebate has been given to taxpayers. 8th pay commission will put money in the pockets of government employees. Unlikely that this money will be saved or spent on roti, kapda, makan. Hence, more likely that this money will be spent on experiences, airline, consumer durables, travel, tourism, healthcare, education. These are the sectors where we will see more spending happening. But please remember, you have to bet upon entrepreneur. While on one side, consumer FMCG companies are talking about slowdown. On the other side, a sports company like Decathlon, which is in unlisted space, is growing at a rapid pace. So you will be betting upon entrepreneurs within consumer discretionary space and also banking and financial services.
Okay. No, I take your point about, the entrepreneur. Even in the week when Hindustan Unilever was announcing 1% volume growth in their 3Q numbers, Jayen Mehta of Amul was on our channel saying that he grew 15% in the third quarter and 20% in the month of January. So yes, it differs from person to person and company to company. But as you said, banking. Rajiv, first, before I ask you about credit growth, when is the first deposit cut according to you? We will just have the liquidity numbers flashing as you talk. I mean, it is almost 7 lakh crore that has been pumped in by the Reserve Bank, and the Reserve Bank has not yet even declared its dividend. So when is the first deposit cut for you?
To start with, 2025, I think 2025 was really all about fiscal, monetary, and regulatory tightening. But I think the good news really is that in each of these cases, I think we're now beginning to see, some ease off. You've seen both the regulators talk about the fact that, there is a cost to compliance as well. Second is from a fiscal perspective, where the tightening was 80 basis points in 24 and 25. The expectation is that it'll be about 40 basis points in 25, 26. And we've already seen, as you rightly pointed out, a significant amount of easing of liquidity. But to the question that you're asking, what's happened so far is that obviously the pass-through has happened on the asset side because much of the assets are now priced to market-linked rates. But liquidity, even after all this, still continues to be in deficit. And we do anticipate that once the government spending happens over the year end, as we come into first quarter of next year, we should start to see liquidity in surplus. And to the point that you made, as dividend starts to get added, the RBI dividend gets added to the system, I think we will see easing of liquidity in the first half of the year. And most important, durable liquidity, I think, is the key that one needs to look for. And so therefore, I do believe that the first deposit cuts we will probably see in the first quarter of next year.
First quarter. So May perhaps is, the middle of the first quarter. So I'm picking up May. But I want to pin all three of you to the financial sector first, because that's the sector that didn't do that well in the year that was. Soumya, how many rate cuts? Because initially rate cuts is pain for banks and pleasure for NBFCs. So how many rate cuts?
No, I think, Latha, if you ask the specific question on rate cut, as of today, if you look into the inflation trajectory for next fiscal, I think most of the numbers in the first 7 to 8 months are looking below 4% as of now. So from that perspective, with such a benign inflation scenario,
yes,
I can expect at least a cumulative 75 basis point rate cut in addition to the 25 basis point rate cut which we had. So the terminal repo rate could be anywhere between 5.5 to 5.75% at the end of the day.
Okay. Now that will be very big for the bank's asset book, Nilesh. Do you think this year also will be a year of NBFCs rather than banks?
I think within banking and financial services, men's will be separated from the boys. Okay. The deposit franchisee will become the biggest driver for bank or NBFC. Ability to mobilize low-cost resources will be key differentiator. The second will be credit culture. We do see stress in unsecured lending, microfinance. It seems to be bottoming out probably over next quarter, but one will have to wait and watch. And finally, within banking and financial services, valuation makes all the difference. This year, we have seen some of the lower valued companies in banking and financial services giving good return. So it's not just one factor which is going to drive banking or NBFC. It's combination of your low-cost deposit franchising, credit culture, and valuation combined.
Okay, absolutely. So on all those three, what is your best guess, Rajiv? To what extent will margins be under pressure? If it is, as Soumya says, 3 more rate cuts coming, April, June, and if not August, at least September, if they were to come. Will it be a 20 bips pressure on margins? Is the margin pressure over? So margins, and then I'll come to credit growth.
I also agree with Soumya in terms of rate cuts. I think we also expect somewhere in the vicinity of 50 to 75 basis points. But I think the key as far as transmission is concerned is that liquidity needs to improve. We can't have a situation where overnight rates are at 6.25 and 1 year deposit rates retail are around 7.25, 7.5.
Okay, one minute. Rajiv, 1 minute.
That gap needs to narrow.
No, I agree. Can we assume, since we have to assume about next year, can we assume the authorities have learned their lesson? We are probably going to get a 2.5 lakh to 3 lakh crore dividend from RBI. If you do the math, there are some people who are expecting even more, but maybe RBI will moderate it to that number. And government, unlike last time, will not make the mistake of sitting on the money. Chances are that they will spend. Assuming they spend, what is your guess in terms of margins and in terms of credit growth?
I think what you've spoken about is only one part of the problem. I mean, we'll still have to deal with rupee volatility and what RBI is going to do with that rupee volatility as well. But I think it's fair to say, I mean, it's simple arithmetic that if the asset side gets repriced first and there is still continued pressure on liquidity and therefore deposit rates don't come down as much as anticipated, you will see pressure on margins, for banks as we get into next year.
Okay, how do you see credit growth? See, one of the big banes of the economy has been that at one point loan growth was even less than nominal GDP, or at least equal to nominal GDP. We are normally used to seeing it better. Do you see it pick up because of all the reasons that we just spoke? Tax cuts have been given, liquidity will be plentiful, rate cuts will come. Do you expect loan growth to improve? Like go back to 12, 13?
Our expectation is, I mean, just going back to all the conversation that we had, yes, liquidity will improve thanks to government spending and the dividend that RBI will pay, and hopefully a more stable rupee environment as we go forward. I think deposit rates will come down, and as a result of that, liquidity will improve. Okay. And our anticipation is that we will get to credit growth of somewhere in the vicinity of 13 to 14% next year, because we also believe that GDP growth will be in the vicinity between 6.5 to 7%, and we can't get there, with a 10-11%, credit growth.
Credit growth, okay, yeah, that's true. But the point is how quickly we get over there. We will have to discuss the big issue of capex and capex hunger from corporates. But before that, Nilesh, let me just complete this argument. What would be your hierarchy within the financial? Where does finance figure in your hierarchy? And within finance, what is the hierarchy in terms of stocks?
In the financial services, we will be underweight capital market related businesses as markets become choppy, and regulator takes action to curb excessive speculation. In the banking space, we will be looking at valuation, deposit franchising, and credit culture together. In non-banking space, we will be underweight insurance space. We think there is still some amount of valuation adjustments there. And in the financial service, in the NBFC space, we'll be focused on more like a specialized NBFCs, for example, which is engaged in auto financing or commercial vehicle financing or housing finances, rather than jack of all trade kind of NBFC. So it's going to be a far more bottom-up stock picking rather than top-down.
Oh, you've given us a lot of clues for that. But what I'm going to take home also is your first sentence that not capital market related entities because you're expecting choppiness. So I have to discuss that. I have to discuss capex. I have to discuss the rupee. All those questions coming back after the break.